Welcome to Stony Finance Lab channel.
OnChain Analytics, utilizing on-chain analysis for more informed cryptocurrency investing. Presented by Joe Corrao, Chetana, Jason Wu, and Kevin Mack. Mentored by Dr. Danling Jiang. For this project, we explore various on-chain metrics that can be used to predict cryptocurrency future prices. We will do a series of presentations throughout the next couple of months to give you an overview of what on-chain analysis is and help summarize metrics, its definitions, and implications to cryptocurrency investors. Presentation 1. Agenda. Our first presentation will focus on giving a brief introduction to the background of on-chain analysis. We will talk about the history and evolution of on-chain analysis and its benefits and limitations. We will then introduce the best on-chain analysis platforms and talk about how they work, and also go over resources you can use on social media to strengthen your knowledge on the topic. At the end of this presentation, we will give you a glimpse of what to expect from our next presentation, and then we'll allow time for any questions you may have. An introduction to on-chain analysis. What is blockchain? To understand on-chain analysis, we must first understand what a blockchain is. Blockchain is a shared, decentralized, distributed ledger database. This digital ledger is a chain made up of individual blocks of data. When new data is added to the network, a new block is created and attached to the existing chain. Cryptocurrency transactions are handled using blockchain technology. What is on-chain analysis? On-chain analysis is an emerging field in cryptocurrency designed to help traders improve their strategies by leveraging information found on publicly available blockchain data. On-chain data versus off-chain data. Going back to understanding on-chain analysis, we need to understand what on-chain data is by comparing it to off-chain data. Off-chain data does not necessarily mean that the data is not on the blockchain. Instead, it means that it's not on a publicly accessible service. In contrast, on-chain data is transactions that are published on the public blockchain and cannot be changed or reversed. So how do on-chain metrics help crypto traders and investors? On-chain analysis is a fundamentals-driven approach rather than one based on hype, sentiment, technical analysis, or word of mouth. Since blockchains offer mass amounts of open and transparent financial data, investors can use this data and leverage on-chain metrics to assess supply-demand dynamics, patterns of buying and selling, market sentiments, and investor behavior at any given point in time.
The first ever on-chain metric was coin days destroyed, or CDD for short, which is simply just how long a person decides to hold a coin. Arguably the most important is network value to transaction ratio, or NVT, as it tells you how much people are willing to pay and thus if the crypto is overvalued or not. This later resulted in the development of network value to transaction ratio signal, which focuses on moving average of transaction volume in the last 90 days. In 2018, unspent transaction outputs started being used to calculate how long a crypto was left in a wallet or to see when the crypto was last moved. By using unspent transaction outputs, people can see the realized capitalization on the crypto, as well as show investors when others are longing or shorting the crypto. Another use of unspent transaction outputs is in hodl waves, which indicates if investors are holding, moving, or buying crypto. The benefits of on-chain analysis are that they illuminate investor behavior and show network health in real time. This tells us that the value of the currencies rely heavily on behavioral factors and the activity of the network. While simple proxies are made available by on-chain data, a lot of metrics estimate certain ratios to provide information about the market and investor behavior. For instance, we can think of market capitalization as the participation of all traders, while realized capitalization can be thought as the participation of long-term investors. After understanding the history of on-chain metrics, we can start to understand the limitations of the metrics. From the history, we can see one of the more obvious limitations is that it's still very new. With less than a decade of historical information, the use of the metrics we have now can evolve or even become obsolete. More effective metrics may stay, but many will change or be replaced. Another limitation is that not all blockchains are made equal. This requires a more detailed analysis when choosing which metric to compare different cryptocurrencies. For example, Bitcoin is focused on the goal of becoming digital gold, while Ethereum's blockchain is intended as a platform to facilitate immutable programmatic contracts and applications via its own currency. Therefore, some metrics may be used to predict the value of Bitcoin, but may be less useful for Ethereum. Lastly, many crypto investors have shown to be short-term investors, which contradicts the use of on-chain metrics. According to Interdax, these metrics are more useful in a long-term investment strategy.
On-chain analysis platforms work in 5 stages: inspecting, identifying, clustering, modeling, and visualizing. Firstly, platforms inspect the blockchain just like anyone can do. Afterwards, they start identifying or highlighting all the wanted data like addresses, values, gas price, and more. Then on-chain analysis platforms start grouping and updating retrieved data. After that, they start creating a data model by applying specific formal techniques. Finally, on-chain data represented in an interactive, simple, and helpful charts. Here are a few on-chain platforms. Santiment, market intelligence platform for cryptocurrencies. The platform focuses on low latency signals and custom market analysis. CryptoQuant delivers market data directly into Python or Excel. This saves time and money for the user to receive the data in the format they want. Messari, data analysis platform for the global crypto community. With their data, the user can invest with confidence. Glassnode strives to bring data intelligence to the blockchain by building applications. Glassnode provides new ways to deliver insights to the blockchain and cryptocurrency.
On-chain analysts to follow on social media. On social media, there's plenty of content to boost your understanding of on-chain analysis, and we would like to mention a few on-chain analysts that are worth following on Twitter. Willy Woo is a leading Bitcoin on-chain analyst, and he is one of the best out there for extracting investment signals from blockchains. He currently writes a paid market intelligence newsletter called the Bitcoin Forecast, which is available on Substack. He is also the co-creator of the NVT metric mentioned earlier. Checkmate is Glassnode's lead on-chain analyst. As mentioned in the above slide, Glassnode is a provider of data and analysis regarding the blockchain. Will Clemente is a 19-year-old that shares deep dives on various on-chain analytics. He works with Anthony Pompliano, and they discuss market conditions every week on his YouTube channel.
So here's a list of Tier 1 metrics we plan on talking about in our next presentation. They can be analyzed for free on glassnode.com. In the next few slides, we will give a small intro to these indicators so that in the next presentation we can dive deeper into their meaning and show how they can be utilized to make investment decisions. So first we have transfer volume, which is basically the amount of coins that have been successfully transferred on-chain. And then we have spent output profit ratio, which sounds complicated, but it's basically whether or not the transaction put the investor in profit or not. And then we have new and active addresses, and as the name suggests, new and active addresses are simply what they sound like. Any address that are being used for the first time to make a transaction, and addresses that are being used to continue making transactions. In the next presentation, we will go more in depth as to what an address is.
Here we will talk about potential metrics 5 through 8. So first we have supply last active plus 1 years, and it shows the percentage of Bitcoins inactive for 1 year or more. More Bitcoins remaining Inactive means more Bitcoins are being held instead of traded, which could lead to a spike in price. Next is stock-to-flow ratio, and it's a popular model that assumes that scarcity drives value. Stock-to-flow is defined as the ratio of the current stock commodity, in our case circulating Bitcoin supply, and the flow of new production, which are newly mined Bitcoins. Bitcoin's price has historically followed the stock-to-flow ratio, and therefore it's a model that can be used to predict future Bitcoin valuations. Then, the difficulty ribbon is an indicator that uses simple moving averages like the 200-day, 128-day, 90-day, 60-day, 40-day, 25-day, and 14-day of the Bitcoin mining difficulty to create the ribbon. Historically, periods when the ribbon compresses have been good buying opportunities. Lastly is the pi cycle indicator, and it's composed of two moving averages, the 111-day moving average and the 2x multiple of the 350-day moving average of Bitcoin's price. This metric shows when Bitcoin becomes significantly overheated and has historically been a good indicator for cycle tops when the bull run is over. Thank you for taking the time to watch our video, and if you want to leave feedback, you can scan the QR code and we'll be able to see what more you want to see. And we just want to remind you that these metrics are subject to change based upon our research and what we feel is the best indicators for predicting Bitcoin's future price. Thank you, and we look forward to seeing you in our next presentation. Thanks.
Thank you for watching this video. Please feel free to like, comment, and subscribe to this YouTube channel.